Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're going to jump in, take a look at the U.S. dollar, which is approaching that potential breakout spot. We'll also take a look in at commodities. Now, recently we've been talking about under the surface, while the indexes themselves are making new highs, we were seeing deterioration in terms of breadth readings in the advanced decline line. Well, over the last few sessions, we started to see that weakness spill over to the major indexes themselves. We're at a couple of very key levels on some of these charts, and we're going to dive deep into that. We're also going to take a look at how far away the market has traded above its 200-day moving average over the last 200 days, and historically what that has meant in the past. So let's jump right in. First and foremost, S&P 500. Now, I'm filming this Thursday before the market opens. We've actually had another move down overnight of about 1%. The S&P 500 is going to open about right here at about that 4360 level. So we have broken underneath of that 4400 level from the moved at the end of July, beginning of August. That is not great, but if we pay attention to what's really going on here, we still have a series of higher lows. And until we take this level out and make a lower low, that long-term uptrend that's been in place in the S&P 500 is still valid. So not great action over the last couple of sessions. After we made a new high, gap down, gap down, gap down 3 days in a row. That's not what we want to see, but the chart itself has not broken yet. When we take a look in at the Nasdaq is going to open down as well. It's opening at about 14,760, so about right in here. Still way above the important breakout level from June. That's what we really want to see. We still have higher lows in place. You could actually call 14,500 back to about 14,100. That major zone right here of previous resistance, which now should act as support there in on the Nasdaq. You break underneath of that, that changes things, but we're not there yet. We come in now, we take a look at the Dow. The Dow is going to open at about 34,600, so about a 300-point drop overnight. So that puts us back down into this zone in here. And this is not what we wanted to see. A breakout only able to hold for a couple of sessions and then a swift move to the downside. But same thing applies. We're not below a previous low. So we haven't made a lower low yet. And if you really want to look at this whole area right here is the important zone. So we want to see this kind of hold on here. If it breaks below that 34,000 low from the middle of July, that would be a change of character. So while the action is not great over the last couple of sessions, the long-term chart has not broken yet. That is the key. All right. Come in now, we'll take a look at the Russell 2000. Now, the Russell 2000 closed yesterday right above its 200-day moving average. Well, it's opening today at 2126, which puts it underneath its 200-day moving average, right? But it is right here on this major level. We have talked about this for a while. I think this is the key to the overall market. The Russell has not accomplished anything over the last 8 months. It has traded sideways. It has not broken down at this point. It has not broken out, just going sideways. We've seen the market underneath of the surface kind of be a choppy mess for a while. This chart really makes that clear. If we fall below that zone of support, this would be a 8-9 month Darvis box that breaks to the downside. That would be very bad. And of course, as we know, mid and small caps are give us that risk-on, risk-off environment. When we see weakness over there, that generally means people are not willing to take on as much risk, and that can kind of spill over to the overall market itself. So we really want to pay very close attention to what's going on here. I think this is the closest to a major level of support. I think it's the most important thing to take a look at. If we hold this zone right here, there isn't a problem at all thus far. All right, so we are paying very, very close to what's going on with the Russell here. Now, let's take a look at the U.S. dollar. The U.S. dollar is right there. It hasn't done it yet, but it is right there at that 93.50 level. Okay, this would, if it were to break out, would then be a higher low, and it would be a higher high over about a year, right? Still in the context of the short-term downtrend here, all right? But in trend, the long-term we are still holding above that key 89 level into that 100 zone. So this very much could be that bottom, a double bottom from 2018 to 2021, and we can head back up. Now, we've talked a number of times about why what goes on with the U.S. dollar is so important. Everything is priced in U.S. dollars. If the U.S. dollars are stronger, commodities and stocks oftentimes suffer that headwind. So we are paying very close attention. More commodities than the stock market itself is it important for. And speaking of commodities, let's jump in and get there. Now, gold is holding on to that important 1675 level. It's bounced back up, has not gotten back up over 1800, declining 200-day moving average, hasn't gone anywhere in a year. We've talked about this a lot. There's really no change in this market. Silver holding above that 22, a little bit weaker action than gold over the last few days. Gold, when stocks come under pressure, is more of the safe haven than silver, which is a higher risk industrial metal, more so than a precious metal. We look in at platinum breaking down. It's almost taking out that low from a few weeks ago. If it takes this out, this is a really a broken chart. Overnight, Toyota announced that they were doing a 40% reduction in production. That has to do with the fact of the chip shortage. And when we look at platinum and we look at palladium, a lot of it has to do with catalytic converters in cars. Palladium, which has been a massive leader for a long time in this space, finally breaking below that 25. You can clearly see we're underneath that 200-day moving average. This chart no longer looks good, and that is a warning sign. So both platinum and palladium do not look good here. If platinum takes out that low from a week or two ago, there's not really a whole lot of reason to be long it at the moment until that chart firms up. We look in at copper. Copper got hit pretty hard last night there as well. It is right at that $4 level, that purple moving average. You see there is the 200-day moving average. It's tested it for the first time since it broke above it last May. First test, 200-day moving average oftentimes acts as very important. The more times it tests, it becomes less and less important. And that's because there's a lot of people that watch that zone. That's the reason why it is important. So what happens here is really, really important. If we see copper breaking down from here, that would not be a good sign for the overall market as well, as that can kind of really show what's going on industrial production-wise underneath the surface. Now, we've talked a lot about oil here as well. Oil is now underneath that 65 level. Here's its 200-day moving average. It's back at that 60 zone, and we've had a couple of really weak sessions from that breakdown underneath the 66. So if you look at this, we came up, we tested that 77 zone, was unable to make that breakout, and now has fallen back below what should have acted as support. The next area of support really is going to be that 57 area, but this chart does not look great. However, when we're looking at it from higher lows, we still would need to, excuse me, there, didn't mean to zoom in that far. We would still need to take out this low right here at 61 to make a lower low. And so that's really what we're watching there in this market. Now I want to jump in and take a look at the emerging markets here as well. The emerging markets are underneath of that 200-day moving average, which we talked about here for a while. Back underneath that 1274 zone, which was the high from 2018. The key is that 1230 zone. If it loses that whole area should act as support, and that would be a bad sign. Now, this is very much heavily weighted to China. I think it makes up about 35% of the emerging market index, and China has had a lot of issues in their market from policy concerns, and has really come off sharply over the last few months, and that is weighing heavily on the emerging markets. I've said it before, there are a number of markets globally that still look good, but as a basket with a heavily weighted towards China, it's a bit of a concern. And when we see this not acting well, that of course is a concern that we have for the overall market, because again, it's very difficult for the emerging markets to be in a bear market while the U.S. continues to rock and roll higher. One of the two is going to catch up to the other. That's usually how it works. That gap usually does get closed. Our market typically tends to be much stronger than the emerging market over long periods of time, but when we see real sharp weakness out of the emerging markets, that usually does spill over because we are a global economy in this day and age. Now, looking at the Dow, I wanted to talk about this 200-day moving average and how far away we've been from it. All right, the Dow Jones is one of the largest moves above its 200-day moving average in the last 100 years. We can see it's been almost 200 days without testing above 6% above its 200-day moving average. It's been almost 200 days, right? If we go back over the last 100 years, there have only been a handful of times where we have been above that, okay? So this has been a very, very, very strong market, trending well above its moving average. When we look at that entire data set, what we see is what we've seen a lot of these over the last couple of weeks, where the short term is not necessarily great. The long term is fine. We're positive 70% of the time, but in the short term, we're only positive 33% of the time. Why might that be? Well, the more we move above that 200-day moving average and stay above it for long stretches of time, the more that rubber band gets stretched. And what this data set's saying is eventually we have to come back down and test it. Now, when you test that 200-day moving average for the first time after a long time, as I said earlier in this video, it oftentimes acts as support and we do get a bounce. And we look at this a couple of months out, 6 months, a year later, the market still is predominantly higher because strength is not a bad thing in the long run. Just when we get a little bit out ahead of ourselves in the short term, that can ultimately be a short-term problem. Now, what I've got up on the screen here is the Nasdaq Advanced Decline Index, and what you can see is we have more decliners than we have advancers for the first time this year. All right, really since last December, we're finally taking that out. So we have noticed as the indexes have continued to make a new high, we have noticed over the last month or so that the number of new lows has been creeping up. And that is showing us underneath the surface that breadth has not been good. And when we look at the Nasdaq McClellan Summation Index, we are finally breaking below that 300 level that has been a key here for the last few years. You can see we had that turn up, and we talked about it a week or so ago. If it continued to head higher, that was going to be a good sign, but if breadth continued to deteriorate under the surface, that would not be good. The last time we saw breadth readings this poor was back in March all the way until May of last year, and then during the weakness we had at the end of 2019. What's going on under the surface here is not a positive thing. All right, markets have a very difficult time continuing to trudge higher when it has very low participation, and this is why we pay very close attention to what is going on in our breadth readings. And when we look at the S&P 500, the number of 52-week highs with no new high in the advanced decline line, meaning they're not making higher highs on an expansion, is one of the highest we've seen in a very long time. It's been 18 times that's happened in the past 42 sessions, and this data set is not a good-looking one for the market long term. When we go a year out, we're only positive 43% of the time. 6 months later, we're only positive 30% of the time. And that's if we have more than 15 new highs in the past 2 months with no new highs in the advanced decline line. If we relax that a little bit so that we can expand that data set and we use 10 instead of 15 here, things do look a little bit better for us long term. A year out, we're about a coin flip whether we are positive or negative. The important thing to pay attention to moving forward is what is going on underneath the surface with breadth. If breadth continues to deteriorate, the market is likely to continue to head lower. If the breadth readings can stop falling and start to stabilize, and we see that advanced decline line start making more highs instead of more lows, then we know that things kind of have turned. And again, paying very, very close attention here to what happens in the Russell. Whether it can hold this zone or not, I think is going to be very telling here over the next few sessions. So let's pay very close attention. If the Russell breaks down here with all the breadth readings and everything that we're seeing, we're probably in for a rough go of it here in the short term. And we do have some cause for concern in the long term when we take a look at the lack of participation in stocks historically. As always, I hope you guys found this information useful. You can reach out to me at mtedeschi at Perspective Wealth Planning or 814-580-9881. I'd be more than happy to talk anything about the stock market with you guys. Stay safe out there. I will see you guys next week. Take care.